A former office tower in downtown San Francisco just traded at a price that would have been unthinkable 3 years ago. A building that carried a loan balance of $558 million sold for $60 million. That is not a markdown. That is not a distressed discount. That is an 89% destruction of collateral value on an asset sitting on one of the most expensive pieces of land in the Western world. This is not a housing crash in the traditional sense. There is no panic in the streets. There are no foreclosure signs on suburban lawns. The headline unemployment rate is still under 4.5%. The S&P 500 is within range of its all-time highs. None of the instruments that Americans are trained to watch are flashing red. And that is precisely the problem. What is happening right now in the United States real estate market is not a collapse you can see. It is a collapse you can only measure. It lives inside loan-to-value ratios, maturity schedules, and debt service coverage reports that regional bank examiners review quietly in conference rooms. The media is not hiding it because of conspiracy. It is hiding it because the numbers require translation, and translation requires time nobody seems to have. So let us translate it carefully, without the dramatics, because the structural reality is alarming enough on its own. The number you need to understand first is $929 billion. That is the volume of commercial real estate loans that matured or are maturing in the United States in 2024 and 2025 combined, according to the Mortgage Bankers Association. Another $570 billion is rolling due through the end of 2026. These are not abstract figures. These are individual buildings, individual loans, individual balance sheets at individual banks, each one requiring a refinancing decision in a rate environment that has completely changed the arithmetic of ownership. When those loans were originated, the federal funds rate was between 0 and 0.25%. Capitalization rates on commercial properties, the ratio of a building's income to its value, were compressed to historic lows because cheap debt made everything pencil out. A building generating $4 million in net operating income could justify a $100 million valuation when money was essentially free. At 6% cap rates, that same income supports a $67 million valuation. At 8% cap rates, you are looking at $50 million. The building did not change. The income did not change. The cost of capital changed, and the math behind a decade of real estate investment collapsed with it. This is not a forecast. It is arithmetic, and arithmetic does not care about your loan maturity extension. The extend and pretend mechanism is worth understanding carefully because it explains why the crash is not appearing in the headlines. When a borrower cannot refinance a maturing commercial real estate loan at a higher rate, the bank has two choices. It can take the property back through foreclosure, recognize the loss, and absorb the hit to its capital ratios. Or it can modify the loan, grant an extension, and defer the recognition of that loss into a future quarter. Banks are overwhelmingly choosing the second option. Federal banking regulators accommodated this behavior explicitly. In a 2023 policy statement, the OCC, the Federal Reserve, and the FDIC jointly issued guidance encouraging banks to work constructively with borrowers facing difficulties, effectively blessing the extend and pretend approach as sound banking practice. The rationale was to prevent a sudden crystallization of losses. The consequence is that the losses are accumulating invisibly, building pressure inside the balance sheets of regional banks that most depositors have never heard of. The Federal Reserve's own senior loan officer survey shows that lending standards for commercial real estate tightened sharply through 2023 and 2024 and have remained restrictive. New origination volume has collapsed. Transaction volume in commercial real estate fell roughly 50% in 2023 from the prior year peak and has not recovered meaningfully. When nothing is trading, nothing is being marked to market. When nothing is being marked to market, the losses remain theoretical on the books of the lenders while being entirely real in the physical world of vacant towers and empty parking structures. The office sector is the most acute expression of this dynamic. National office vacancy in the United States crossed 20% in 2024 for the first time in recorded history, according to CBRE. In San Francisco, vacancy is above 35%. In downtown Chicago, it is approaching 27%. These are not numbers from a recession. These numbers are being posted while the official economy is supposedly in expansion. What they reflect is a structural, permanent shift in how office space is consumed, driven by hybrid work patterns that have proven far more durable than corporate real estate teams assumed in 2021 when they signed long-term leases expecting workers to return 5 days a week. The workers did not return 5 days a week. The data from Castle Systems, which tracks building access card swipes across major metro areas, shows average office occupancy nationally stabilized around 50% of pre-pandemic levels. In coastal cities, it is lower. That means the average office building is operating at half its designed utilization, which translates directly into tenant decisions at lease expiration. When a lease comes up for renewal, tenants are renewing for less space or not renewing at all. the income supporting the building's valuation is deteriorating in real time. And here is where the residential market enters the equation, because these two markets are not separate systems. They share the same lenders, the same municipal tax bases, and increasingly the same borrowers. The lock-in effect on the residential side has been extensively documented, but its mechanical implications are frequently understated. Approximately 62% of all outstanding mortgages in the United States carry an interest rate below 4%, according to the Federal Housing Finance Agency. The current 30-year fixed rate is hovering between 6.7% and 7.1%, depending on the week and the borrower's profile. This creates a financial trap that is holding roughly 25 to 30 million homeowners in place, because trading their current home for a comparable one would mean voluntarily doubling their monthly interest cost. The practical consequence is that existing home sales have fallen to levels not seen since 1995. The National Association of Realtors reported annualized existing home sales below 4 million units through much of 2024. For context, a healthy market historically transacts between 5 and 6 million units annually. The market is not frozen because nobody wants to move. It is frozen because the interest rate differential between staying and transacting has become prohibitive for the median household. This frozen market is artificially supporting residential prices by suppressing supply. But that suppression is not permanent. It is conditional. It is conditional on the four economic forces that override financial preference: death, divorce, default, and job dislocation. These forces do not negotiate with mortgage rates. And as the commercial real estate stress begins feeding into the broader labor market through bank credit contraction, as layoffs accelerate in finance, professional services, and commercial construction, the inventory dam begins to leak. Look at the specific markets where this is already visible. Austin, Texas saw active inventory surge more than 60% year over year in late 2024. Denver's days on market doubled. Tampa's median sale price has retreated meaningfully from its 2022 peak. These are not the result of sentiment shifts. They are the result of affordability constraints, removing the marginal buyer from the market, while forced sellers gradually increase supply. The clearing price in these markets is drifting lower with each quarter that passes. The insurance dimension of this repricing is the most underreported structural accelerant in the housing market today. In 2024, State Farm, Allstate, Farmers, and multiple regional carriers have either exited markets or materially raised premiums in Florida, California, Louisiana, Texas, and Colorado. The departure of admitted carriers pushes homeowners into state-run insurers of last resort: the Citizens Property Insurance Corporation in Florida, the California Fair Plan in California, with premiums that are often 2 to 3 times the private market rate and coverage that is substantially less comprehensive. In specific Florida coastal counties, the combined cost of property taxes and insurance on a median-priced home now exceeds the principal and interest payment on the mortgage. This is not a rhetorical device. It is a monthly budget reality that is forcing selling decisions by households who can service the mortgage debt but cannot service the total cost of ownership. When a household's carrying cost structure breaks, the asset gets liquidated regardless of what the mortgage rate is. The property enters the market, expands local inventory, and exerts downward price pressure on comparable properties. This insurance stress is not captured in any of the headline affordability indices. The mortgage payment affordability metrics tracked by the National Association of Realtors, by Harvard's Joint Center for Housing Studies, by Black Knight. They measure principal and interest against income. None of them standardly incorporate the insurance cost escalation that has occurred over the past 18 months. The actual cost of home ownership in climate-exposed markets is materially higher than the headline affordability metrics suggest, which means the market is even less accessible to the median buyer than the reported data shows. Now zoom out to the banking system, because this is where the residential and commercial pressures converge into a systemic risk concentration. Regional and community banks in the United States, institutions with assets under $100 billion, hold approximately 70% of all outstanding commercial real estate debt, according to the Federal Reserve's own flow of funds data. The largest banks, J.P. Morgan, Bank of America, Wells Fargo, Citigroup, have been systematically de-risking their commercial real estate exposure since 2022, building reserves, tightening underwriting, and reducing origination. The risk has not disappeared. It has migrated to the part of the banking system that has less capital, less diversification, and less access to emergency liquidity facilities. New York Community Bancorp's crisis in early 2024 was instructive precisely because of how ordinary the institution was. It was not a niche operator or a reckless risk-taker by historical standards. It was a well-regarded regional lender with a decades-long operating history that had absorbed the assets of Signature Bank at the government's request. The subsequent recognition of losses on its multifamily and commercial loan book triggered a stock decline exceeding 60% in a matter of days, a credit rating downgrade, and a liquidity stress event that required emergency capital injection from a private equity consortium. The regulators and the institution both described the situation as manageable. The speed and severity of the market's repricing suggested otherwise. The systemic implication is the following. NYCB was visible because it was publicly traded. There are approximately 4,600 FDIC-insured banks in the United States. The majority are privately held community institutions whose loan book composition is not subject to daily market scrutiny. The Federal Reserve's own Financial Stability Report has repeatedly flagged commercial real estate concentration as a material vulnerability for community and regional banks. As of the most recent data available, roughly 300 banks have commercial real estate loan concentrations exceeding 300% of their Tier 1 capital, the internal regulatory threshold beyond which supervisory attention intensifies. These institutions are not necessarily insolvent today. They are interest rate sensitive, duration mismatched, and collateral dependent in ways that make them fragile under sustained stress. The stress is sustained. The maturity wall has not passed. The extend and pretend loans are not being resolved. The collateral values supporting the loan portfolio are continuing to drift lower as each quarter passes without a transaction market to establish clearing prices. There is a specific channel through which this banking stress reaches the residential housing market that is rarely discussed in consumer financial media. It operates through construction lending. Regional and community banks are the primary source of acquisition, development, and construction financing for residential builders. When these banks tighten lending standards, not because of regulatory mandate, but because of capital constraint, the pipeline of new housing supply begins to compress. Less construction lending means fewer housing starts, which means less inventory entering the market over the next 18 to 24 months, which means the supply-demand imbalance in the residential market persists even as demand continues to weaken. The housing starts data reflects this dynamic. Single-family starts have recovered modestly from their post-rate hike lows, but multifamily starts have declined sharply, falling more than 30% from the 2022 peak as construction lenders have pulled back. The apartment oversupply that materialized in Sunbelt markets in 2023 and 2024, particularly in Austin, Phoenix, Atlanta, and Nashville, was the result of a construction cycle that peaked before rates rose. That pipeline is now being worked through, and on the other side of it is a meaningful reduction in new supply at exactly the moment when rental demand is being driven by households priced out of home ownership. The rental market stress interacts with the commercial real estate stress in the following mechanical way. Apartment buildings, particularly those acquired between 2019 and 2022 using bridge loans and floating rate debt with aggressive rent growth assumptions, are now facing the same maturity wall as office buildings. The math is different because apartments actually have tenants, but the debt service coverage arithmetic is under similar pressure. Rising operating expenses, insurance increases, property tax reassessments, and management cost inflation have compressed net operating income even in markets where rents are nominally flat. When the loan matures and the debt service coverage ratio is below 1.0, meaning the building's income cannot cover the loan payments, the refinancing options are severely constrained. The syndicated real estate investment community, the network of private operators who raised equity from retail investors to acquire apartments during the zero-rate era, is experiencing a wave of distress that has not yet produced major public visibility but is generating substantial activity among workout attorneys, special servicers, and distressed debt funds. Investors who committed capital to these deals through crowdfunding platforms and private placement memoranda are receiving capital call notices and distribution suspensions. The losses are real. They are simply distributed across thousands of small investment accounts rather than concentrated in a single visible institution. Now, consider the municipal finance dimension. Commercial real estate is the largest source of property tax revenue for major American cities. Office buildings in central business districts generate a disproportionate share of the property tax base relative to their land area. When the assessed value of a commercial property is challenged, as thousands of major tenants and building owners are currently doing through formal assessment appeal processes, the city's projected tax revenues compress. Chicago, New York, San Francisco, Dallas, and Denver are all facing material budget pressure from commercial real estate assessment appeals that are being filed at record volumes. These appeals take time to adjudicate, often 2 to 3 years, but their resolution creates retroactive refund obligations and prospective assessment reductions that create structural holes in municipal budgets. A structural hole in a municipal budget has a specific and measurable effect on municipal bond creditworthiness. The $4 trillion municipal bond market is the financing mechanism for American infrastructure, public schools, water systems, and public safety. When the credit quality of the underlying issuer deteriorates, the yield demanded by bondholders rises, increasing the cost of financing for cities at exactly the moment when they need to increase spending to address the social consequences of economic stress. This is not a theoretical feedback loop. It is currently being priced into the spreads on bonds issued by several major American cities. The connection between housing market stress, banking system fragility, municipal budget deterioration, and ultimately the macro credit environment is not a series of separate crises. It is one crisis with multiple expression points. The mechanism connecting them is the repricing of collateral that supported a leveraged financial system built on the assumption that real estate values move in one direction. That assumption held for 12 years following the post-2008 recovery. Low rates, quantitative easing, and institutional capital flows into single-family homes and commercial properties created a reinforcing cycle of appreciation that validated the assumption continuously. Every year that passed without a correction made the assumption feel more like a law of nature rather than a contingent historical artifact. Capital allocated on the basis of that assumption is now encountering the limits of its validity. The Federal Reserve's own data shows that unrealized losses in the U.S. banking system peaked at approximately $690 billion in late 2023, before declining modestly as rates pulled back from their highs. But that figure measured securities portfolios. It did not capture the unrealized credit losses embedded in commercial real estate loan books held at historical cost under current accounting standards. Independent analysts at firms including Claros Group estimated that if banks were required to mark their commercial real estate portfolios to current market values, the resulting capital impairment would render approximately 285 banks technically insolvent by the end of 2024. These are not small institutions. Their collective asset base is substantial. Their combined deposit base represents the savings of millions of ordinary Americans who have no visibility into their institution's loan book composition, no ability to assess the quality of the commercial real estate collateral securing those loans, and no early warning mechanism beyond the institution's quarterly earnings disclosures, which are prepared under accounting standards that were specifically designed to avoid exactly the kind of mark-to-market transparency that would reveal the pressure. This is not fraud. It is the legal, regulatory-sanctioned operation of held-to-maturity accounting and regulatory forbearance, working exactly as they were designed to work. The design intention was to prevent panic. The design consequence is that the market cannot efficiently price the risk embedded in these institutions. When risk cannot be priced, it cannot be managed. And when it cannot be managed, it accumulates until it becomes unmanageable. The credit default swap market on regional bank debt has been pricing elevated distress probability throughout 2024. The KBW Regional Banking Index has persistently underperformed the broader market. Institutional investors who understand the loan book composition of these institutions are expressing their views through derivatives and short positions that are not visible to the depositor sitting across the lobby. The trajectory of this dynamic does not require a trigger event to continue. It requires only time. The maturity wall will continue to produce refinancing decisions that cannot be resolved economically. The extend and pretend loans will continue to mature. The collateral values will continue to drift lower in the absence of a transaction market. The municipal tax base will continue to erode as assessment appeals are adjudicated. The insurance cost spiral will continue to price out marginal homebuyers in climate-exposed markets. Each of these processes is already in motion. None of them requires a catalyst. They require only continuation. What changes when a catalyst arrives is the speed of recognition. The St. Louis AT&T tower trade was a catalyst in a specific market. It forced a public acknowledgement of a price level that the extend and pretend framework had been deferring. When enough of these transactions occur in enough markets, the fiction of the book values becomes increasingly difficult to maintain under external audit scrutiny. At some point, auditors begin requiring more conservative valuations. At that point, the reported losses crystallize, and at the moment of crystallization, the institutions that have been operating on thin capital margins face the question of recapitalization. Recapitalization in a stressed environment has a specific sequence. Internal capital generation stops being sufficient. Management approaches existing equity holders for additional investment. Existing equity holders assess the dilution math and frequently decline. The institution approaches the private capital markets. Private capital demands a discount and governance rights that existing shareholders find unacceptable. The regulatory conversation intensifies. The FDIC begins contingency planning. The institution ultimately either finds a buyer among the larger banks or enters resolution. This process is slow. It is unglamorous. It does not produce the dramatic visual of a bank run that Americans associate with financial crisis. But it is happening, and its pace is not independent of the commercial real estate maturity schedule that has been publicly available in the CMBS servicer reports and the FDIC's own call report data for anyone who chose to read it. The residential market's next 12 months will be determined by the interaction of three competing forces. The supply restriction created by the lock-in effect will gradually weaken as the interest rate differential between staying and moving compresses, either through rate declines, income growth, or forced selling pressure. The demand destruction created by affordability constraints, insurance cost escalation, and property tax increases will continue to remove buyers from the market. And the credit contraction generated by banking system stress will progressively reduce the availability of mortgage and construction financing. The outcome of that interaction is not a dramatic overnight repricing. It is a slow, persistent, quarter-by-quarter reduction in transaction volume and price discovery, occurring most acutely in markets with the highest concentration of pandemic-era buyers, the most significant insurance market withdrawal, and the most exposure to commercial real estate-dependent employment bases. Phoenix, Austin, Nashville, Charlotte, and Tampa all satisfy multiple criteria on that list. These are the markets where the data will move first and most visibly. They are also the markets where institutional investors most aggressively deployed capital between 2020 and 2022, buying single-family homes at scale on the assumption that rental income would justify the acquisition prices. Several of these institutional owners have already begun net dispositions as the yield math has deteriorated. When institutional portfolios are net sellers, they compete with individual sellers for a constrained buyer pool. The clearing price is the price at which the marginal buyer, financing at current rates, carrying current insurance costs, paying current property taxes, can justify the monthly payment against their income. That number is lower than the current list price in most of these markets, by a margin that the transaction data is beginning to confirm. None of this is hidden. It is in the public data, it is in the FDIC call reports, it is in the CMBS servicer watch lists, it is in the municipal budget projections, it is in the insurance company market exit announcements, it is in the Federal Reserve's financial stability reports. What is hidden is not the data. What is hidden is the synthesis, the translation of discrete signals in different market segments into a coherent picture of interconnected structural stress. That synthesis is what the title of this video is actually about. Not a conspiracy of silence, not a media cover-up, but the entirely ordinary human tendency to evaluate each piece of negative information in isolation, to accept the extend and pretend accounting at face value, to assume that because the stock market is near its highs and the unemployment rate is below 5%, the system is fundamentally sound. The system has embedded within it a leverage cycle that is in the process of repricing. The repricing began in commercial real estate and is transmitting through regional bank balance sheets into construction lending, municipal credit quality, and ultimately, residential affordability. The speed of transmission is slow enough to avoid headline visibility at any given moment. The direction of transmission is not in doubt. The upcoming decisions that will determine the pace of this repricing are the following. The Federal Open Market Committee's rate path over the next 4 quarters will determine whether the refinancing math on the remaining maturity wall produces more or fewer jingle mail events. The FDIC's examination cycle for the roughly 300 highest concentration commercial real estate banks will determine whether regulatory forbearance continues or begins to tighten. The Florida and California insurance market stabilization proposals currently before their respective state legislatures will determine whether the cost of home ownership in those states stabilizes or continues escalating. The municipal bond market's willingness to absorb new issuance from cities with deteriorating commercial tax bases will determine whether those cities can fund the social services that make them viable residential destinations. None of these decisions has been made. All of them are in process. The system is not frozen. It is not resolved. It is moving through a repricing cycle that began in 2022 and is not complete. That is the accurate description of where the United States housing and credit market sits in 2026, not crashed in the way the word implies sudden finality, but in the process of discovering a new clearing level at a pace determined by accounting standards, regulatory forbearance, and the physics of capital flows. The market is tightening structurally, quarter by quarter, balance sheet by balance sheet, maturity by maturity. And the distance between where prices are reported and where they would trade in a fully transparent, fully liquid market is wide enough to matter for every decision you make about where to hold capital for the next several years. That gap is what the data has been quietly telling us for the past 18 months. The question is not whether it closes. The question is how quickly and who absorbs the adjustment when it does. Follow the data. The next quarter will tell you more.